Good afternoon and welcome everyone to CRI's webinar, Cost Segregation Studies, Opportunities for Contractors. I'm Tom Carmichael, a partner with CRI, and I serve as the industry line leader for our construction practice. A couple of comments just before we get started. A copy of today's presentation is available for you to download in Zoom chat. If you have questions, definitely ask them using the Zoom questions Q&A feature. We've left some time towards the end, but we'll be monitoring them as we go as well. And if we can't give you an answer, we'll communicate that to you and we'll get back to you after researching it further. Today, I'm excited to have with us Jeff Cover as our presenter. Jeff is a consulting partner out of our New Orleans office who, with his team, has performed cost segregation studies for over 10 years. That's included over 800 studies completed, representing nearly $2 billion in assets analyzed, with none being challenged by the IRS. He's a CPA and is actively involved in the American Society of Cost Segregation Professionals. And in the very little free time that any CPA has, Jeff teaches corporate and partnership taxation at Loyola University. Jeff, I'll turn it over to you as I'm eager to hear about the opportunities that cost seg studies provide.
Thank you, Tom, for the introduction and welcome everybody here. I hope this will be a enlightening and informative little presentation and a little bit different from the typical cost segregation presentation. And like Tom said, there are a lot of questions that surround this topic. Please do feel free to drop them in the Q&A section. If there is a question that seems specific to a situation or property or whatnot that you might be in directly, we will reach back out to you and maybe get you a more directed answer. With this said, let's dive right in. As you mentioned, this is myself and Tom. We're going to be talking about today with respect to cost segregation opportunities for contractors. First, kind of diving into a high-level refresher on what cost segregation is, either for those who are not intimately familiar with it, or those who just need a refresher because they have not seen it in a minute or two. We're going to discuss a little bit about how you guys can utilize this to add value to your relationships, and what collaboration looks like in general. And then we're going to tell you a little bit about what green benefits might exist and how you guys might be able to use those as well to benefit your relationships with your customers. And lastly, we're going to talk about some governmental entity opportunities out there that you guys can be capturing if you're not already capturing already, as well as discuss a little bit the changes that are coming down the pipeline for 2023 forward as a result of the IRA. Now, since it is the holiday season, we are going to do this in the vein of giving the gift of tax deductions. As I stated, the whole purpose of this presentation is to educate you guys, the contractors, on how to build more value in your service lines that already exist by increasing some bid competitiveness, strengthening your relationships with your customers, and hopefully all the while giving back money to your customers, and sometimes a significant amount of money to your customers in the form of tax deductions or tax credits, all while really doing nothing yourself except bringing us to the table as an introduction. So this said, let's actually start with the high-level refresher of what cost segregation is. So for those who are not familiar, a cost segregation and a cost segregation study is in essence a strategic tax tool that allows the owner of any real property, a hotel, a warehouse, tenant strip space, anything that is a building, residential and or commercial, to access some of the deductions that exist in the property in the form of depreciation, and to accelerate those deductions up in time, taking some of that value against their tax liability and their taxable income in the current period, and not having to wait the 39 and or 27 and a half years to take that deduction. The studies themselves are supported by case law and IRS guidance, and they utilize a regularly applied and universally applied cost segregation methodology. In its essence, it is a tax deferral opportunity. And it can be quite the powerful tax deferral opportunity if used at the right time in conjunction with other pointed tax planning. There are different types of studies out there. There is your normal cost segregation study for a study that is for a property that is placed in service in the current period. This would be something that is placed in service in an open tax period for which you have not filed yet. You have look-back studies, which is essentially the same thing as the first one, except for a study for a tax period that occurred in a prior period where you've already filed your tax return, but you want to access the benefit of those deductions. Very similar in process, and it can actually be taken in the current year without having to go back and amend those tax returns. A very common approach. There are also asset disposal studies whereby you have a piece of real property that you've been depreciating and you're going to remove significant components. There is specific IRS guidance out there on how to perform this calculation, and the cost segregation studies or the same process will support the taxpayer's position on how to do this. And then lastly, you'll have your energy efficiency studies. You might have heard these called the 179D studies or the 45L studies for commercial and or residential properties that have energy efficient components either installed in them as part of new construction or installed in them as part of a significant renovation. In general, a cost segregation study, what it does is it provides the credibility and dependability necessary for when you, the taxpayer, or your client, the taxpayer, takes the benefit to support and defend that taxpayer's position. Now, I know there are a number of contractors on this call, and that is the purpose to discuss these benefits in the context of being a general contractor who may do commercial and or residential construction or consultation. This is not a construction audit. Those are very, very separate tools that you may or may not be familiar with. But this is not a construction audit. We are not going in with the intent to review and provide an opinion on your work or the contract or the efficiencies or anything of that nature. This is simply a tool to take the end cost of that building and find all the building components that are within that cost and take a favorable tax position so we can access a deduction now and not have to wait for it. And most importantly, access a deduction with sufficient credibility and dependability that if it's ever challenged, you're able to defend your tax position. So that's a lot of words. I'm a numbers guy. I think this is easier to see in an actual example here. So on this slide, what we have is an example of what a cost segregation study might look like. If we look on line 1, we can see a column for before segregation, and this identifies, say, a $2 million piece of real property that was placed in service. It's a commercial building, let's say a warehouse. Absent a cost segregation study, you would really have no basis on how to identify which categories these costs should go into. If there's certain components like specialty lighting or machinery, equipment-based components, or specialty electrical that doesn't have to do with the general operations of the building, you wouldn't be able to provide a good allocation of value that includes a reasonable allocation of all soft costs to take a tax position on. So you'd have to take that asset over 39 years on the straight line method, meaning evenly over 39 years. If you're able to perform a cost segregation study and go through that asset and identify all the components within that asset and provide a value to each one of those components, you'll have the ability to break that asset out into 5-year and 15-year categories. And let's say in this example, it's $250,000 in 5 years and $350,000 in 15 years, to more favorable methods where you're going to be recognizing that over 5 years and or as we've seen since 2017 with the Tax Cuts and Jobs Act, be able to depreciate 100% of that value in the current period at once. An extremely powerful tool because that would give you access to about $600,000 in depreciation, which you can use or your client could use to offset their taxable income in the current period. If we were to assume, say, in a 40% tax rate, we're looking at about $240,000 of additional global cash flow generated in year 1 simply by investing in a cost seg study. Again, very powerful, very real, and very widely used tax tool to access this deduction, with a lot of, I guess, case precedent behind it that allows it to move forward smoothly without having many issues in front of the IRS. Now, we're going to talk about this in the context of your relationship with customers on the end, because as you go through your bid process and you're discussing the cost of your contract, if you can bring to the table to them a solution that immediately recaptures some of that investment value that they're putting into that property, opening up cash flow of $240,000 in the first year, you're effectively producing a solution that reduces the costliness of your bid. Now, obviously, this can be something that can be captured by any client, but if you bring this in as a strategic tool, either in the bid process or as part of your customer relationship, it can inherently strengthen that relationship by, providing immediate feedback. Immediate value that the taxpayer can use. See no questions here, and this is a fairly straightforward example. I'm going to move on. I will say right now the property class presented 39 years is for commercial property. If you are somebody who works in the multifamily space, those properties will recognize a 27.5 year life, but the economics are generally the same. The depreciation is generally the same. And frequently in residential properties, we'll find significant benefit from cost segregation studies just based off of the nature of the assets being created and built. Now, just a gentle reminder, I did mention, that currently under the Tax Cuts and Jobs Act, since September 27th, 2017, we have been in a very favorable bonus depreciation arc where we've had access to 100% of the assets under 20 years. So that's all your 5, 7, 10 to 15 year assets, including some 20 years for any properties that have those types of assets, where we could take that entire deduction at an election if we choose in the current period. We are unfortunately seeing the end of that 100% bonus era at the moment, and starting for properties placed in service 2023 forward, we're going to see them start decreasing as this policy sunsets from 80% in 2023, 60% in 2024, 40% in 2025, down to 20% in 2026, and then presumably going to zero after that. Now, I will add a little flavor from the last speaker I heard from the IRS, though they are not able to specifically state anything, and this is also stated by a gentleman at the Tax Foundation. Depreciation has become a very bonus depreciation has become a very regular benefit in the IRS world. It has become something very normalized in the political spectrum as well. I think everybody's expecting that there will be some sort of renewed bonus depreciation rule following the sunset, but as of now, the market, as well as a number of the think tanks, don't seem to think that there's going to be any expansion of the 100% until this bill sunsets as it's presented. So excellent benefit. What this does mean, if you're thinking about adding value now to some projects you have and you think you may or may not place in service before year end or after year end, trying to go for that certificate of occupancy or substantial completion certificate or something that you and or the taxpayer are able to put in the ground to say we've placed our asset in service in 2022, not 2023. It is beneficial to start having those conversations now, either directly with your client or maybe reaching out to us and discussing where you are in the project and what you may be able to do to evidence placed in service. If you're sitting there on that cusp of punch out as you get close to year end and minor costs in January, but maybe not your CO. With that said, I'm going to migrate forward from the refresher. If we're looking now, why we're here, how can you guys use this to add value? How can this be used by contractors as a tool to add value? Well, the initial one is simply, you're getting a dollar-to-dollar recovery for your customers. You are bringing in kind of on day one as a solutions partner, not only the ability to provide the construction product that you guys are already out there to bid for, but you're going to bring built-in value to that relationship by adding tax value. And with tax rates increasing and tax complexity increasing, these significant deductions can go a long way in increasing that relationship. We've had experiences with contractors we've partnered with over the years where they have developed extremely strong relationships by being able to deliver a kind of packaged cost seg product that moves with their construction process. So by the time the customer gets it at the end of the day, the one who's financing, or the investor group financing the project, they're able to walk away with both their building in hand, ready to rock and roll, as well as a tax benefit that they can pass along to the owners or the investors or whatever partnership group might hold that asset. And there is no timing issues, as well as there's no uncertainty as to what the tax benefit might be down the road. Now, outside of just passing on that dollar recovery, that immediately dollar recovery to the customers, we have seen these same clients who utilize cost seg as part of their customer relationship projects be able to go into the competitive bid process as they present their their bid for construction or their bid for services with a copy of an estimated benefits package from us, the cost segregation team, to be able to show them, hey, in addition to us delivering this product for this cost, we're going to deliver this product with this cost with this estimated tax benefit on the backside, which brings to the table what could look like more what is the word I'm looking for? More favorable bid. So with those two first bullet points, you're solidifying and diversifying the solutions you're able to bring to the table. And we all know, in this complex age we live in right now, being a solutions partner is just as important as being able to show up and provide the product that you paid for. And this is great because this is something, as I go into the details later, you really have to do nothing for. I believe Nancy Pollard asked a question about CPE. This has not been set up for CPE given the nature of the content here, so there will not be polling questions included. Lastly, coming down the pipeline, there's going to be a number of green benefits that are coming online in 2023. We have already seen a lot of market excitement over this. We see a lot of people starting to plan their construction policies and equipment choices, the timing of placed in service, et cetera, based off of some of these new benefits coming in 2023, as well as looking further down the pipeline at any ESG considerations, the environmental, social, and governance considerations, which is gaining a foothold in the market. We also expect there to be a further demand on tools like cost segregation studies and green energy certificates and tax certificates to support ESG positions, either as required by compliance or as desired simply for your social forward-facing presence in the market. So I think it's pretty straightforward, how this can bring value to the relationship here. It is an extremely powerful tool. And for those who are either not familiar or clients who are not familiar with it, it can have extremely positive, short-term cash benefits for clients that are immediately recognized in the current tax filing period. And for clients who put real estate in service every year, they can continue to realize benefits year after year after year as they put more and more projects together. It's a highly used tool that unfortunately too many clients aren't aware of. So a lot of times we find people who bring this solution to their clients do bring them something that they're not aware of. And it's either because their CPA is unable to perform this, they have never heard them themselves, or they think it's too complex of a benefit for them to be engaging in. And at the end of this slide, I'm going to give you guys a couple of examples of projects we've worked on, from smaller to medium to large, just to kind of give some context as to this is a benefit for everybody, not just the largest of the developments out there or the smallest of the developments. But in the meantime, I think the biggest question most people have on their hands when we start this discussion is, what does this actually look like? This sounds like a lot of work for us. Why would we try to bring this solution to our clients if it's just going to put more burden on us? So to belay that initial concern, We, the CPA firm here, shoulder nearly 100% of the burden of preparation of the benefits of the documents for this benefit. The study itself is drafted and prepared by us. All tax positions are defended by us and taken by us, as well as all the consultation necessary with the client, and the client's CPA is on our shoulders. We have a streamlined process on our end, where we utilize our engineers in-house to review your design and specs in whatever native formats you guys use. So it requires really no work outside of communication and upload to a link on your end to provide us the information. And again, we're not coming in, and our engineers are not coming in to review your documents and give you feedback on anything, unless you guys would like some assistance in understanding the best way to comply with 179D or 45L standards, which we'll talk about later with respect to green benefits. We're just there to interpret your drawings and make sure what you guys have prepared for your clients and what your as-built plans are for your clients are appropriately translated into a tax benefit for them on the other side. So it requires nearly no work on your end outside of a few uploads. And even at the introduction point, we, as part of our process, educate your client and or you or their CPA on the benefit and the planning around the benefit to make sure that the benefit is understood and that it actually meets their tax needs and it's something that they will be able to use. So once again, there's really nothing you guys need to do except bring this to the table as a solution. Let's say you are a contractor who is in the space where you build a specific style of building, and your customized solutions are a portfolio of available structures where you kind of work in a singular space, work with singular materials, have a general design that maybe you tailor a little bit for your clients based off of their specific needs, but it's generally the same type of construction and envelope buildup. We can work with you ahead of your clients' specific needs to develop templates for your style of structures based off of your standard drawings, material choices, site layouts, etc. So when we actually bring that solution forward to your client, it can be even more competitively priced from a cost segregation standpoint, bringing them the same value, but at a much smoother, quicker, and more defined pace, where the benefits that we propose at the beginning, and I'll get into the benefits process here shortly, but the benefits we will bring and propose and name at the beginning of the process will pretty much be in line with the end product. This is a space where we have found a significant amount of value. Well, we've partnered with larger developers or contractors who say build multifamily housing, and they build a very specific style of garden style apartment complexes, or maybe it's a very specific style of tilt wall warehouses. Whatever it might be, we'll develop a template, and then as they go develop those for their clients, we just come on the backside, tweak it a little bit with consultation with the plans that they provide, and then are able to quickly after place in service provide the taxpayer and their CPA a copy of a report that supports whatever tax positions they're going to take, immediately giving them that dollar recovery that they need and they probably want, or they want and they probably need. So what does the actual benefits process look like? What does the estimate process look like? How does it actually work with us? And the next two slides, I'm going to cover kind of how this works. And if this was something that you guys were interested in pursuing, or if you had a client that you think might be able to benefit from this, or if you're looking at your own business saying, hey, we have a couple of pieces of real property here, we haven't taken the benefit of cost segregation yet. Maybe this is something we want to look at to see if we can save ourselves some money. First and foremost, we provide free estimate benefits at any stage of the development process. So the estimation process and the process of going in and consulting with your client and helping them to understand the benefits of cost seg that's on us, because it's an introduction to the product and it's an introduction to us. We can review and pretty much give a good solid accurate benefits analysis at any stage in the development process. We can do it at the beginning, project conceptualization, when things are just an idea on the whiteboard and you kind of have an idea of it's going to be a 2-story, apartment building with a pool and a parking lot and maybe a little bit of a fitness center there. You're going to have 8 of those. We think it's going to cost $13 million. We can give you guys a proposal based off of that. We can also review initial drawings and cost estimates in the planning stage when you kind of gone past the conceptualization stage and we're down to a little bit more nuts and bolts of cost estimating. Or if you guys are shovels in ground and you're currently building and you have an idea of where you are to budget to actual and you have a more tailored idea of where your costs are going to end and you obviously are working off a set of plans, we can review it at that stage and provide a benefits estimate, what the tax benefit's going to look like at placed in service. And then, of course, as kind of mentioned on the first slide, we can do it at any point in time after CO is received. Cost segs, we frequently find ourselves going back into clients' portfolios and looking at assets that were placed in service in prior years because the last 3 years they didn't have a tax liability, but all of a sudden they're in a position where they are making more income than their tax deductions can offset. And all of a sudden they need a deduction where they never needed one before. We have gone up to 10 years back in time to provide cost segs, and in some cases even further on. I say 10 years here, it's kind of an industry norm to say 10 years or $750,000 in cost. It no longer is beneficial to do a cost seg study, and that's simply because if you're actively taking depreciation with the asset, you're further and further through that depreciation as time goes on. You don't get depreciation twice, but you can bring it forward in time. But this being said, we are happy to look at any property and give our opinion as to think if we think this is a good target. So this could be at CO, this could be 1 month after CO, this could be after the tax year, this could be 10 years after the tax year. We can bring a solution to the table. So let's say you have a target and maybe you have a client and you're interested in bringing the client in for a proposal, or you yourself have an opportunity that you're curious about and you want to bring to the table. When do you bring our team in? Well, really at any point in time. As mentioned before, at any point in time in the study, we can go in. If you think there's a point in time to start discussing it, just bring us in and we can take the relationship from there. As I noted, we'll be happy to answer any of the questions you, your client, even the client's CPA or the business partners may have. And this is something that we do, as I mentioned, very frequently, at no effort on your end. We're able to join as a solutions partner where we join the calls with you and we are, representing solutions hand in hand with you, or we're happy just to be that handoff that says, hey, we got a guy and this guy can do it right. Don't worry about it. Here's his email, reach out to him and they'll take care of you. And we can reach out to them, keeping you updated on how it's going, but work one-on-one directly with them to not take any more time out of your pockets. So moving on to some green benefits, right? We've talked about cost seg, we've talked about accelerating depreciation based off of just identifying those components. But there are some other great benefits out there, specifically the 179D related to energy efficiencies for commercial buildings and or multifamily houses, 3 stories or higher, and or the 45L residential credit. Now, these credits and benefits are changing from in 2022 to 2023. So we're expecting a big change in what the benefit looks like and who pursues the benefit moving into 2023. So right now I'm going to give you a little bit of a high level on both of those types of benefits. Answer any questions if anybody has them. So yeah, 179D, this is an energy efficiency based benefit where you're comparing the current building under construction to a standard model building from a past set of energy efficiency standards. As of now and through the year end of December 2022, you can take a tax deduction. This is a deduction, not a credit, of up to $1.80 per square foot for energy efficient commercial building property. Now, this is building property where it has been either originally placed in service by the taxpayer, so it's new construction by the taxpayer, placed in service through December 31st, 2022, or it's a significant renovation in which the renovated components have been placed into the building and in service through December 31st, 2022. As of now, it's $1.88 per square foot. As I'll note on a further slide, this is going to be going up to $5 a square foot, giving access to a lot more taxpayers to take this benefit, because obviously the more square footage you have, the higher the benefit's going to be. This is a great tool that goes hand in hand with cost seg, especially for new construction. If this is something you're developing, it's cheap and it's easy to add this on top of the existing benefit. They work hand in hand, just giving you additional access to that real property that take the deduction now. Typical energy savings improvements include lighting elements, heating, and air conditioning elements, your HVAC element systems, as well as the building envelope components. And we'll typically see the HVAC and the lighting in significant renovations where the interior of a building is being gutted and replaced, as well as, from time to time, the building envelope components, if the insulation and roofing and whatnot is being replaced as part of the process, or windows, etc. For an idea of how the deduction works and why larger properties are more beneficial, let's say you have a 50,000 square foot property and you're getting 60 cents a component, so 60 cents for the lighting, 60 cents for the HVAC, and 60 cents for the envelope. Your tax deduction would be additional $90,000. For a 300,000 square foot, this would be up to $540,000. So a fairly healthy benefit, given you typically do not have to specially select components. Most of the components being placed in buildings these days will bring the taxpayer to a position where they'll qualify for the 179D study. Now, it's not a guarantee, but the manner in which you're comparing it to a standard building, the standard building is a little bit older, and as a result, just your typical building components today meet and exceed that standard. Now, going forward, 2023 forward, so anything placed in service January 1st, 2023, we're going to see a significant increase from $1.80 a square foot to $5 a square foot. This is huge. Is that it gives existing taxpayers who claim the benefit, over double the benefit back, almost 3 times the benefit, as well as for those taxpayers who may have had smaller square footage footprints where it didn't really make sense to go claim that benefit. Now it might make sense because the benefit itself is greater and that dollar investment in the energy efficiency study is worth it. Now, one thing to note that I don't have listed in here is to take the 179D credit and or to take the 45L credit, you do require an engineer's certificate signing off that they have modeled the reference building compared to the standard building, and they have followed all the IRS guidance necessary to say that that building has met and exceeded the standards required by 179D or 45L. Unlike the cost seg, where it is not a requirement that the cost seg be there, it is simply there for credibility and defendability, which is extremely important. These do require an engineer who is familiar with the tax benefit and who has modeled it, and who either has the appropriate certificates or is using the appropriate software modeled the benefits and is supporting it within their study. So that is an important thing to note. Simply because you've met the LEED standards or the green standards doesn't necessarily mean you've qualified for the tax credit. So just be wary. But this is again something that we can assist your clients in, or you in, if it's applicable to you. It's not listed here, but in addition, we've worked with clients for property compliance around solar tax credits in various states, either when they have brought investors into the deal or they're trying to claim the solar credit themselves. So this is a tax credit. Residential rental credits, a significant portfolio of the historic tax credit renovation, or the historic renovation credit, which is very popular in older cities or cities where there's a large inventory of renovations, if this is a space that you work in, as well as LIHTC, low-income housing, and other specialty tax credit programs around real estate. So if these are being packaged together or used in conjunction, we can be that one-stop shop to help them through all their compliance needs from cost segregation to green benefits to understanding the local and or the federal programs for their real estate. Now, here's an exciting one for you guys, for the contractors out there who do work with governmental entities, especially who have done work in the past, or maybe who do work with nonprofit entities. Those green benefits, the 179D benefit, that $1.80 a square foot, can be passed along to eligible designers and builders, the architects, the engineers, the contractors, environmental consultants, energy service providers, whomever they may be. The benefit that the governmental entity, who is not traditionally a taxpayer, cannot take, that can be allocated to the designer and or builder of that component. So if you are a contractor and you are working with, say, a school system, or maybe you're working with the local government and you're working on a renovation of a building that's going to be occupied by that governmental entity, if you are, you can have the benefit if those components qualify and meet and exceed the needs of the 179D deduction, you could qualify to claim that credit on their behalf. An extremely good incentive, to which we see a lot of times, you know, the governmental entities will be happy to sign that over to you because it's promoting, you know, green energy efficiency. If you choose, you can also choose to put that negotiation into your contract, but I think a lot of people see that that's not even something brought up in the contract negotiation process, if it's just brought up that it's allocated to them. Now, you do have to be wary as that there is a process and appropriate forms that do need to be filled out to claim that allocation on behalf of the contract, on behalf of the governmental entity. It is not complex, but it does require somebody who's familiar with it, and we are familiar with that process, as well as it can only be claimed once. So being aware that it's out there and negotiating the allocation early. So say a subcontractor or another contractor who is involved as well doesn't claim that on your behalf. Now, the exciting part is come January 1st, 2023 and forward for the foreseeable 10 years, this deduction can also be transferred from most 501 entities. So your nonprofit entities, your churches, other religious organizations, things that are your 501 nonprofit entities. So not your governmental entities, but your not tax-paying nonprofits. This deduction is going to be eligible to be transferred from them as well, which means for the 179D allocation, there's going to be a significantly larger pool of opportunity out there for designers and builders and contractors to go claim some of the allocated benefit on their tax returns. The 179D rules are changing. You're going to go to $5 a square foot, but there's going to be some compliance changes from the way it's been the last good bit of time. But you know, either way, you're going to want somebody who is familiar with the process and can walk you through it and make sure that the client is qualifying, that you're qualifying, and that everything is tight and supported. So when you take that allocated deduction or your client takes these benefits, that they're in a defendable, incredible, and supportable position. So this nonprofit thing, we're expecting really exciting things from them, from this, simply because this is an untapped market out there where there's a lot of construction around nonprofits occurring at any given point in time, especially renovations as they enter older spaces or as churches utilize monies to reopen their congregations after COVID. To go capture some of these benefits as the eligible designer or builder. Now, in addition to everything that was stated before, and I think I mentioned this at the very beginning, the study that we will be providing not only provides the necessary support for the current tax period deduction, but will also support any and all of your future disposal deductions as well. So if you perform that cost seg for your client on or yourself in year one, and you take that tax benefit, it's going to give you everything necessary for in the future if you perform renovations and you remove portions of your building, or if there is a disaster or something that occurs that damages part of your building, and you need to allocate and identify the value of those components that were either removed or lost in a casualty event. The cost seg will support that future deduction. So you get to use it once on the front side, and then you could potentially use it once again in the future without having to pursue an additional cost. So in light of the holiday season, cost segregation is the gift that keeps on giving. A little tongue in cheek there, but we are going into the holiday season, so might as well have a little fun. So this end, I think it's good to, if you're not familiar with size of properties that can benefit, to get an idea of, through the eyes of our representative portfolio. This is everything from, your hotels, your office buildings or dialysis centers. It could be something as simple as a shotgun house. Here's an example because I'm from New Orleans. That was $610,000 basis. That was an artist studio. That was their place of business, and it was a commercial property in zone such, and the entire property was taken. We were able to get cost benefit for even that small of a property. I think a historic tax credit project was also done that as well as part of a renovation. To your more mid-sized buildings, your larger hotel complexes with some meeting space within, larger office complexes with land improvement and site improvement benefits there, grocery stores, downtown locations, in addition to kind of the larger projects where you have these really complex structures, large structures, multi-building, multi-facility, multi-use structures, whatever they might be. All of these properties can benefit from all these deductions that were just stated. And you guys as contractors can bring values to each one of these relationships simply by making the introduction and doing nothing more. So with that, we haven't had many questions come up in the panel as we've been moving along. If there are any questions, please pass along. So we have a question that came in. Are cost segregation studies deductions only applicable against the cash flow of the building being studied, or can be taken across a portfolio of properties? That is a great question, and this is something that we can help taxpayers and their CPAs understand. The answer is, and it really depends, it depends heavily on the taxpayer situation. But if it is a pass-through entity, it's possible that accelerated deduction can be taken against taxable income on other properties that roll up in the ownership string. So it is possible that a pass-through deduction can be used to offset income from other sources. If it's all owned by one company and all your taxable income's in the same company, then very frequently that deduction can be used to offset the taxable income generated elsewhere, because you're looking at taxable income globally for that one entity. And then even if you have multiple partners who are invested in it, one partner might get a portion of the deduction passed up, and depending on the nature of that investment and the nature of their tax position themselves, they may be able to use that accelerated deduction on income elsewhere. Now, I will caveat that heavily with, it is very specific to the taxpayer's position. There is a lot of things that can impact that, from limitations at either the entity level, the nature of the income, and other tax planning opportunities. But I think the best thing to do and the most diligent thing to do would be to have the discussion, see what it looks like, and then decide in conjunction with the CPA, is this something that we think they can take and benefit from? And if it is, then move forward. So the answer is yes, but it depends. Are there any other questions? That was a great question. Thank you.
Jeff, you've answered this earlier,
Sure.
but I think it's a question that bears maybe answering again, because it does come up often. And, that's if a study is performed, after a project is completed and put in service, do those deductions generated from the study, you have to amend the tax return going back to the year, that the project was completed, or can you run that through, at the time when the study was performed?
Great question. Great question. And here's the great part about cost seg. This is a deduction you can claim without having to amend those prior year returns. Without getting too into the weeds with forms and sections and numbers and whatnot, There is a Form 3115 and a Section 481A adjustment that can be utilized to take that deduction in the current period without having to open up any prior tax returns. That is an obvious concern for taxpayers and clients, so that if you open up a tax return and you amend it, you're going to be drawing attention to yourself. You do not have to do this. And even in that vein, it is in an automatic change. So you can simply claim it on your open tax return. This form is specific, not all CPAs or clients have seen it before. But as part of our product and process, we help fill out that form. So the CPAs know how to utilize it, know how to input it, and know how to claim it on their end. So it is a good question. It's a very relevant question, because I think, as I kind of stated earlier, people hear something in the prior tax period. The first thought is, no, I don't want to amend my return. We'll let this one sleep and just say we've learned our lesson. No, you can go back and you can claim those assets at any point in time in the past, in the current period, without having to reopen anything. Thanks, Tom.
Okay, well, thank you, Jeff. There's no question that cost segregation studies are an opportunity for contractors to create value for their clients. If you have any additional questions, certainly reach out to either Jeff or myself, and we'll be happy to discuss them further with you. And with that, thank you for attending.
Thank you, everybody.